everybody. What's up? It's Billy Nash. It's episode 15 of my podcast, Luxury Real Estate with Billy Nash. And we had an incredible weekend, an incredible wedding weekend at Mar-a-Lago for my family. Everybody was in town, and there were fireworks at the wedding, and there was also fireworks in the banking system. So I got a call from my boy, Jason Rash, Where's My Money podcast, and wanted to do an emergency roundtable to talk about everything that went down over the weekend with SVB Bank. Holy moly. This is going to be a good one. I hope you enjoy it, and I'll talk to you soon.
All right, welcome back to Where's My Money? My name is Jason Rash, and today we're discussing an important, relevant, and current topic, the SVB bank collapse. I've got three other gentlemen in the room with me today, and all of them I brought in. I specially reached out to them to bring them in to comment. I'm going to let them go around the room and introduce themselves, but I got Billy Nash in the house. I got Howard Cognac in the house, not to be confused with the liquor brand over here. And I've got Jason in the house as well, from the host of Find the Money podcast. Feel free to go around the room, gentlemen, and introduce yourself.
So this is Billy Nash. I'm one of the top real estate agents in the country for luxury real estate in South Florida, but I do deals all over the country. I've been in the business about 7 years. I've sold over $500 million in luxury real estate. I'm also a former private banker for 22 years in New York City. And some of the places that I've worked for are Credit Suisse, Morgan Stanley, and I was there for the demise of Bear Stearns.
The demise. I love how you said that.
That was a rough day.
Go ahead, Howard.
Yeah, how you doing? I've been in the mortgage business my whole life. Before that, I was an investment banker. That's where I started. And recently, I sold my mortgage tech business to a private equity firm in 2021 and semi-retired. Took a year off, got bored, and now I'm doing consulting and podcasting and a lot of other fun things.
How much you sell that company for?
$185 million.
There you go. Getting some of that street cred out there, man. You got to leverage that. Go ahead, Jason.
I'm Jason Soman. I'm a divorce forensic accountant and a business valuation analyst here in South Florida. I help couples during their worst times value the businesses, help divide up the marital estate, and I'm honored to be here today, Jason.
Hey, it's my pleasure to have all three of you in the room. And by the way, I'm telling you, not me as Jason, but this Jason over here that I'm pointing to, he knows his stuff. So if you are going through a hard time and your husband just hid some money from you, you need to find somebody. That's a real thing. I didn't know that until I interviewed him was interviewed on his podcast. You guys ready to roll?
Let's do it.
All right, let's do it, guys. So here's the deal, man. Two banks went down this week, and what I believe where there's smoke, there's fire. But here's the thing that I want to talk about, okay? I want to talk about the demise of this bank, how this happened, the quick timeline, like the unbelievable, just poof, just gone, evaporated. So let's dive into this thing, man. Let's first of all talk about how this happened. Who wants to jump in?
I'll jump in.
Go ahead.
It's been a few years of the loose monetary policy. I mean, 10 years of low interest rates. And that caused a lot of risk taking. And the bank absolutely did not hedge their position because they bought a ton in 2021, 2022 is when they got an influx of cash because of all the loose policies from the Biden administration bailing out from COVID.
Are you saying free money was flowing in the streets, right?
Absolutely.
You could bring a rowboat through there and just go right through it, right?
It's a printing press.
Yeah.
And that causes inflation. So they caused the inflation, and now they're increasing interest rates. And when the SVB got this money and bought long-term treasuries, when the interest rates started jacking up, the value of those bonds started going down, which wiped out their equity, and they didn't hedge against it. And that is the biggest thing here. Everybody's blaming everybody else. Blame the manager of the bank who did not hedge their position. I've been in the mortgage industry 20 years. And when you go lock a loan, there's somebody on the other side that's taking the opposite side of that trade to hedge.
Right.
So if the market turns on you, you could honor that rate to a customer. That's how they do it. It's the same thing. They should have hedged that portfolio. But the problem is, all these kids over the last 10, 15 years coming out of Wall Street, they've seen one dimension of this market, and it's low interest rates. They've never seen the opposite side. And now they're starting to see that, and they're not prepared or educated for it.
Billy, your thoughts?
So if you think about it, SVB Bank had 60,000 small business accounts relationships.
That's a lot right there.
A lot. So you think about all of these companies that came out of Silicon Valley, and the majority of them, okay, were flush with capital because they're PE, they're in the portfolios of the private equity firms that raised the capital. All that capital went into the bank. These businesses had exclusivity with SVB. They couldn't move the money out of the bank. So there alone is a red flag when you can't move your capital from one institution to another. It's non-diversification. So there you will see probably changes in the regulatory bodies change that from here on out. So every disaster creates not only opportunity, but changes in the way people do business. So there is a lot more coming down the pike. This is just a dead cat bounce in the markets the last 2 or 3 days.
Yeah.
Right. Where it's Tuesday. So we've seen another bounce today, but I look for the other shoe to fall over the next 30 to 60 days. And there's going to be more big ones coming.
Yeah. Jason, what do you think about what these gentlemen are saying over here?
Absolutely. So I think that this is kind of also a symptom of this social media era, right? Like, I think I heard on the news it was $4.2 billion an hour was getting taken out of this bank.
Ooh, I mean, how do you even get that much money out? It's not like you can walk up with a bag that big to the bank. So how is it coming out of the bank?
Because I think this is almost like the GameStop phenomena, right? It's like everyone's on Twitter, everyone's texting, "Hey, get the money out of SVB." So I think what Howard was talking about, I think is a part of it. But what really caused a lot of stress and what made them sell that investment at a loss, which really took that, essentially killed them, was the rumors flying around like, hey, you got to get your money out of Silicon Valley Bank. And Silicon Valley Bank has a very high concentration in the startup community out in Silicon Valley. So, news kind of spreads like wildfire there. So I think that this is the second and third biggest bank collapse since Washington Mutual. And it all happened within 3 days.
95% of the deposits, might have been 98% of the deposits on hand for SVB were over $250,000.
That's unreal.
Think about that.
That is unreal. That's a staggering amount of money.
Think about the cash that's flushing around Silicon Valley.
That's wild, man. It's here's what I find staggering, man. So I did this timeline. I read a report, right? Like on Monday, everything was fine. Last week, we're talking about Tuesday, they started experiencing what they called a cash crunch, and I think that's downplaying it. More like a cash crisis is what I would call it. Wednesday, right? So Tuesday afternoon, they started saying, "Hey, did you hear what happened to SVB Bank? Well, this guy is a big investor. He's an angel fund investor, and so he's investing in a bunch of these other companies, and he's in a meeting on Tuesday, and he's all of a sudden Tuesday night, by the end of Tuesday, that meeting, he's trying to wire his money out. And then Wednesday he wakes up and he's like, the tsunami of withdrawals and rumors like you talked about on Twitter just started accelerating. Like it just became unbelievable wave. And by Thursday it was a full court press run on the old bank. You know what I'm saying? Like the old school run on the bank, man. And then Friday, the whole bank was gone. I mean, just billions, just wiped out, billions. I mean, I find it staggering. I mean, I'm like, if these guys can go down, what other banks can go down?
Anybody, but what's happening now?
Yeah.
There are governments stepping in.
Yeah.
So where's the risk now? Where's the investment? If the government's going to backstop everything?
Yeah, that's the other thing I was going to talk about, because I was reading the article that Billy sent me from Janet Yellen, right? Or Yellen over there. Is there Janice or Janet? Janet. And she was talking about, we're not going to do this. This is Sunday. This is how fast this thing is escalating, right? Sunday, she puts out an article. We're not backing them up. Everybody's going to lose their money. We're not stepping in. There's procedures and regulations put in place. This is the reason why we did this in 2008. We're not going to have a repeat. And all of a sudden, Monday morning, we're going to bail everybody out.
Yeah, Ken Griffin said this morning, who's the owner of Citadel, one of the wealthiest guys in the world, he said there was a huge mistake.
On whose part?
On the government's part. We should have let it fail. Everybody will learn a very big lesson, and then we move on from here, and it would have affected probably nothing. That was his opinion. So everybody's going bananas this morning about what he said. In a way, it's creating now an environment where a bank can say, I can do whatever I want, because I'm going to get backstopped. So it's kind of a weird situation.
What I'm concerned about is what you brought up in the next 3 to 5 weeks out. I'm concerned that these small banks are going to lose depositors because everybody's going to run to the big banks.
100%.
Because the big banks are more regulated than the smaller regionals. In 2018 and 19, the Trump administration dropped some of the regulations for the smaller banks. And you need these smaller banks for the communities. Yeah. They can't all go, because if that money leaves the smaller banks and goes to the big banks, it's going to be lent out to all the big corporations and overseas. It's not going to go back into the community.
It's gone.
So that's a big issue we haven't seen unwind yet.
I heard somebody say yesterday, if this was a small bank in Arkansas that dealt with a lot of farmers, would we have stepped up like that to protect them?
Good point.
Right? If it was a mom and pop, the manufacturing, farm equipment, would we have come in that quick? Probably not. So I think there's a little political agenda as well with this backstop.
And so I was reading on Twitter this morning that during the 70s and 80s, there was over 1,000 bank failures. Like banks fail just like any other business. So I think that, it is a important point that the government recently has been propping banks up. They don't want the banks to fail, but, sometimes failure is a way to kind of improve the system and improve banks. Banks should compete. And I also think that they shouldn't have a bailout from the government because exactly what you said, it's going to incentivize people going and taking risk, the bank owners. It's kind of similar to student loans too. It's like you make it so easy to get money, next thing you know, college tuition is like, out of control, right?
Right.
So
there was no risk officer at this bank for 9 months.
That's my biggest concern. I'm just like if there's no chance of failing, then why not just take these people's money and just go do whatever you want? Just put it all in crypto.
But there was nobody like doing stress tests and assessing the risk of the positions that they were taking for almost 9 months. I mean, that's just,
I think
to me, it's crazy.
Why they changed their mind, the government, is because they realized this is a specialized bank. It invests in VC. Like you said,
Correct.
They make you keep the money in the bank. That's part of their mojo. So they finance you. They give you a line, but say, you got to put all your money there. This would have affected a lot of VC startup companies that you can't make payroll. These people will be out of business.
Right.
And those are innovators of the future of technologies, healthcare, things like that. That all goes away.
Do you think that's why the government stepped in?
Absolutely. Absolutely. There's more than just backstopping it. I think they stepped in because of not only the ramifications of a run-on bank because of the social media. What you said, that wasn't around 15 years ago, 20 years ago.
We weren't all connected.
Right. You weren't all connected.
Right.
Now it's instant information, scares people, and the issue with all the VC companies. Yeah. It's unbelievable. I was looking this morning, was it this morning or last night? Like Roku has $480 million over there. It's like,
yeah.
You're insured for $250,000. Like, how does that make sense?
Because they couldn't move it.
They couldn't move it, exactly, and that's an issue. So, these guys got to manage. That's right.
Can they hold them there, like to keep their money there?
Well, they made them sign exclusivity when they raised the capital to from the VC firms to go public.
So why would they do that? I'm just very curious. Because
it's an amazing business model.
Absolutely.
They is it illegal?
They leverage the deposits.
Exactly. We're going to first of all, they were one of the best banks advisors in the country for VC companies. So there was an advisory arm to that business as well. Right. From an investment banking standpoint. So there was tons of fees that were made. That's why this bank will get bought. And to get rid of the entire bank's management, there's some pretty smart guys that are at that bank. Just some of the, they just didn't let it loose. So we'll see what happens with management. They said everyone's fired, but they're going to need these guys to unwind the thing.
Somebody, yeah. Go ahead.
Yeah, I think this is a good lesson in putting all your eggs in one basket. It's especially in this higher interest rate environment. You move interest rates a little bit. There's a whole reverberation, right? Like, so interest rates go up. These tech companies then have a higher cost of capital. It's more expensive for them. They're getting squeezed. They need cash. So they start pulling money out of the banks, right? So if you're exposed to one industry or, I think in any business, right, you need to think about what's the worst thing that could happen. And how do I prepare for that when things are okay? And I think, you could listen to Jason's podcast and learn all about how to stay safe in your investments. But I think one thing it's important is to not put all your eggs in one basket.
There's another thing too, that's interesting. There is no doubt in my mind, this is again, just my opinion, that they knew this was coming at least a month ago. And they were trying to friggin' stem the hole in the boat. Right? Yeah. Because Goldman Sachs had the failed capital raise last week. Yeah. You don't just call up Goldman in an hour and go, hey, I need to raise $50 billion in an hour. It's kind of a tough thing. So they had a relationship. Yeah. And there's no doubt that they saw this coming a month ago. When I was at Bear Stearns 6 months before we went out of business, we were getting calls from our repo desk saying, hey, do you have any clients that will loan us cash for security?
Was that a red flag for you?
100%.
Did you start preparing at that moment? Like, I need to save my money. I may be out of job here.
That was in September, and we went out of business in March. So in September, we were getting calls from the repo desk saying, hey, do you have clients? I want to lend cash to the firm.
Wow.
Excuse me, we lend us cash for their securities.
Right.
And that was the overnight lending because we were levered up 34 times to 1 every night.
Wow.
34 times to 1.
That's insane, man.
That's a time
insane leverage.
Absolutely.
Yeah. So let's go back. Well, here's the thing, man. I totally agree with you. I think if this was a bank out in Arkansas that was loaning farm equipment, I don't think they would have stepped in. I think they would have just let them fail. Now, the question that we have to ask ourselves is, number one, is this type of thing going to go on? Because we have social media now that's just fanning the flames. I really think that you're onto something because, before the Wall Street Bets run up of the GameStop saga over there on Netflix, right? You could check that out, how that actually all unfolded. But I mean, it's a situation where like you get all these people together, number one, and then you get panic and fear because like Howard said, it's instant information. So they're like, oh my God, this must be true. Oh my God, we got to go to the bank. Like I was saying before when we first started this podcast, I mean, people are on social media. I need to run to Bank of America right now and get all of my money out. And I'm like, number one, I don't think that's practical. Number two, the likelihood of them having all of that money, like I don't think they carry more than like 50 grand in cash in the banks, right? They got to order that stuff, right?
Absolutely.
Yeah. And I mean, so I'm just so how would a run on the bank? Let's walk through that, gentlemen. Like how would a run on a bank start, like in your mind?
The way it did last week.
How?
That social media, Twitter, and I mean, they were, and the VCs, the big VC firms that invested in all these companies, like, go get your cash out because you got to make payroll. And that's just a cascading effect. It happened to us at Bear Stearns.
Right.
We needed an emergency loan on Friday because we were, the night before, everything was fine. And then Friday morning, it was not fine.
Don't ask questions. Everything's fine. I like the voice.
But again, this stems to the monetary policy of the government not coming in sooner and starting raising rates slower. Instead, they knew they were behind the 8 ball. So they decided last year, we got to catch up.
Right.
And they raised them too fast, which now depreciated the assets that were on the books of the banks. And it's causing a lot of issues. So we have to have people look at the balance sheets of these banks to understand what really happened from this interest rate. I think the Fed needs to pause here and look at that before they keep going with these rates.
They're going to raise them again next week.
They're out of their mind to do that.
That's what I'm saying. I mean, I'm like, well, what's the purpose of raising the interest rates? Let's dive
inflation.
They don't want to lose their credibility. They don't want to lose their credibility. That's why they're going to do it, but they shouldn't.
All right, so let's talk about this right here. So you say they're going to raise it. Why do you think they continue to raise interest? By the way, I like his shirt, man. Me and Billy both. I told you we were brothers from another mother. Man has on a black V-neck T-shirt just like me. I got fresh, clean tees. Is that a fresh, clean tee?
This one's actually about 2 weeks old.
Oh, there you go. It's all good though.
No, so I think that the Fed will continue on the path of destruction. They're going to continue to raise rates through the summer because they want more things to break, and it's all about credibility. The real estate market, the business that I'm in, is definitely slowed down. We don't really see a big collapse in prices, but if you look at just year over year from January across the United States, actually Miami, there's 67% was the number that I read this morning, volume of from last year to this year. So they're definitely taking some cream off the cake in the real estate market. And other things are still happening, but you're still seeing robust earnings for certain sectors. You're still seeing inflation numbers that are coming that are still overheated.
What's driving it? Like what is driving inflation? Because I'll go out here. There's still so much cash flushed, and there's also inventory wise. There's inventory in certain industries.
Supply chain issues.
Supply chain, right? So there's more. And keep it real simple. People want more things that are available for them to buy, so it drives up prices. Eggs are still friggin' $100 for an egg.
That's unreal.
The cause behind it is energy costs. Energy costs everything, farming, travel, it's energy costs. And the Biden administration shuts down all our energy independent stuff here when he took office. And if he didn't do that, we wouldn't be in this position right now. But he did do that, and that caused inflation plus all the bailout money that they did after COVID. It's just it's a train wreck. It's a nor'easter, and what's going on. A nor'easter that's going on up in Jersey and New York right now.
You don't have to raise taxes. All you have to do is raise energy costs, and then it taxes us in a way that it doesn't have to be on your, doesn't have to be on your tax return, but we're getting taxed every single day.
Yep.
Yeah, I think that I forgot what the expression is, but when the tide goes down, you find out who's swimming naked.
That's right? Warren Buffett, man. WB up in the house. Yeah,
I may have even heard that on the Find the Money podcast. I mean, Where's My Money podcast. But yeah, I think that this is exposing a lot of frauds, right? Like the FTX. Like once everything's not on the up and up, you start seeing, well, who are the Ponzi schemers out there?
And they out there, though. They are out there for show.
And I think that this is the tip of the iceberg. I think there's going to be a lot of people who were, because when they raise interest rates, they cut the froth, right? And there's a lot of people who've been surfing on the froth for the past few years. And I think things are going to get problematic. I don't think that means that everyone is doomed, right? You're still in control of yourself. What's going on in the macroeconomy still may not affect you personally, but I think that this is just the tip of the iceberg in terms of frauds being uncovered. People who have been riding the wave on the froth for a long time. I think it's really going to separate the people who are running a real business, right? A business that makes money and generates profit to their shareholders versus a business that's just some speculation, some app that makes no money and no one has any idea how it's going to operate.
Every market meltdown, the frauds get uncovered. Look what happened in 2008. Who did they discover when everything collapsed?
Bear Stearns.
Bernie. No, we weren't frauds. We were just fucking over leveraged. We were just completely over leveraged.
Right.
But who came out of that? Bernie Madoff.
Madoff, yeah.
Right? No, Bear Stearns was the fourth biggest investment bank in the world. We were an excellent company.
How did you guys collapse again?
We brought some of the, we were just over leveraged.
Okay, got
it. And the real estate market got crushed. So we were, all the CMBS and, MBS, that's what killed us. We were so over leveraged, and then a run on the bank. All the institutions started pulling their money out.
Yeah.
So
Same thing that happened here.
What happens in the investment banks is Bear Stearns was an excellent firm. I miss Bear Stearns. Ace Greenberg was an amazing chairman. When he became chairman emeritus, Jimmy Kane took over, and Jimmy kind of let the company kind of fall apart. And when we were collapsing that week, Jimmy was at a bridge tournament. So to tell you how interested he was in saving the business. No, Bear was an excellent firm. But in the summer, there were some massive deals that we had done. Massive deals. And what happens is the investment banks would take those deals, put them on their balance sheet. We then turn them into securities and sell them to institutions at a coupon, all different layers of risk, right?
Right.
And during the summer, before Bear collapsed, there were some major transactions that were done, billions and billions and billions. And what happens is we keep it on our balance sheet. We give some to Merrill, we give some to Morgan Stanley, we give some to Credit Suisse, and then you chop it up into different securities based on different types of risk and appetite.
Right. And
the institutions then circle it because they like this particular coupon, this particular industry. And then what happened is the cotter pin came off the front wheel and the economy started to choke.
You forgot about the rating agencies.
Exactly. And the
this is good stuff.
Exactly. No, he's exactly right. And the rating agencies came out and said, this is AAA paper. This is AA paper.
Didn't Warren Buffett own that rating agency, by the way?
Yeah.
Just throwing that out there.
So that's what happened. So then everything started to fall apart in September. In October, and all the institutions, the big money, the big money managers that were saying, okay, I'll take 600 million of that piece, I'll take $1 billion of this piece, I'll take 200 million of this piece. Well, then put it in our fund. Well, guess what? All the paper that they circled, they canceled. You know what? We're feeling a little risky here. We're going to back out. So all that paper was stuck on the balance sheets of the investment banks, and that began the trickle effect and the downward momentum spiral, which caused the collapse in 2008.
And then they go and blame the loan officers,
of course,
for selling that stuff. Not that they created it.
Said,
hey, we got no income verification loans over 125%.
Ninja loans, baby. Ninja loans, no income, no job.
Loan officers didn't create that. Wall Street created those products.
Yeah.
Right?
We call them the loan officers that were putting them out. They called them liar loans because there were no income doc loans. And there was a ton of that shit.
Absolutely.
So 06, 07, and 08. And that created a lot of the demise.
Yep. Yeah. So let's actually like circle this for just a moment. Okay. So here's the thing. Okay. I think that number one, Warren Buffett owned the company that stamped all those loans and said they're good, right? Moody. I think he owns a company, Moody's, and they're like, hey, this is good. We're going to rate this as AAA, right? And then Warren Buffett steps in and says, hey, look, I know you've all collapsed, but let me come in and save you guys. And he got an actual guarantee from the government. I think he was going to make 10% on his money or something like that. And we're talking billions, hundreds of billions of dollars that he lent them, man. You can't even lose. But let's bring it back in just a little bit here, okay? Do you think that what we've seen with the SVB bank, do you think it's possible that's going to trickle down to other banks? Historically, that's what we've seen too in some of these situations, that it It's a contagion, like a pathogen. It just gets into the banking system. Do you guys think that this is possible?
I do think it's possible. I don't know at what speed it's going to happen. Because they're going to try to prevent the run, and that's what they did by stepping in.
But what caused it right there at that bank? Why wasn't it at some bank in Arkansas? Why was it at SVB? Like, why would that specific bank?
I heard what you said, but I was hearing that, so I think it was David Einhorn or one of the big money managers started pulling their money out, and then another big money manager.
But why?
Maybe they read the financials and realized this is a train wreck.
I think people that understand. I think there was somebody in the bank that tipped them off and said, "Hey, dude, we're in big trouble here."
Could have been.
That's what I think.
And I think you're going to see in the next 3 months, if not sooner, there's going to be some institutions that bought puts on that bank before that money started to get pulled off. Wow. And there was hundreds and hundreds of millions made, and that's going to be an issue.
Yeah.
Yeah, I heard that there was, the people who are playing chess, right? Not all the people playing checkers last week pulling their money out. The people playing chess, they were, I think, as early as March 7th, there was a lot of people shorting the stock or buying puts.
Exactly.
And I think that I think it's going to keep happening, right? Because I think people are going to see the exposures that this bank had, and then they're going to start either pulling their money out of banks that have similar exposure. I think the market is going to punish companies that have exposure because of this event, right? It just highlights all, it's like someone gets in a crash and doesn't wear a seatbelt. Everyone else is starting to wear a seatbelt again, right? Because they see what could happen if you have this exposure to these assets which are bonds, which when interest rates go up, the value of a bond goes down. A 2% bond's not as valuable when rates are 4%, right?
Right.
So exposure to bonds is a tough place to be right now.
So you guys think that this is going to happen again? Like in the next couple of weeks, you think there's going to be another bank go down?
It's just the old expression where there's smoke, there's fire.
That's what we opened up this whole entire podcast with.
There's always trickle down. I mean, look what happened when Bear blew up, and then it was Lehman, and then it was, you know what I mean? So it happens. It's going to happen. Anybody
connected to that bank's going to go.
But look what happened back then. The government let Lehman and Bear go under and protected Merrill, and
you got to wonder why that happened.
Right? but everybody got in a room and cut a deal. That was what happened that day.
Yeah, probably so. Hey, we're going to give you some information. Absolutely. Now here's the question. It goes back to the Janet Yellen thing, saying we're not going to back it, and then all of a sudden the U.S. government comes in and says, "Hey, we're going to go ahead and back this." I mean, I don't know where that cutoff line is to like, "Hey, look, we're going to step in here, or we're not going to step in here." I don't know what criteria makes them come in and step in and say that, but I want to give our listeners a little piece of some sort of something they can take away from this, to where like they know they're safe. Because I mean, at the end of the day, whenever they start seeing stuff online, like they don't know it. They're not an expert. They just don't know. They assume the individual that's possibly saying this on Twitter is the expert, right? Oh my God, I do need to go get my money out. Maybe I do need to go get my money out of Bank of America or something like that. I want to touch back on a few other things here in a minute, but I want to talk about some tactile things they could take away. So the big thing that they were saying at the very beginning of the SVB bank collapse was everybody who's $250,000 or less is insured through FDIC. Okay. Now, if you go to any bank, you get that as long as the bank is a member of the FDIC branch. You don't have to sign up for it. It's automatic. However, what most people don't know is that if you actually have a joint account with your spouse, it's insured up to $500,000. And some people are like, "Oh my God, it's $250,000." But what do you do if you have like $10 million? What do you do with it? I'm asking you guys.
I mean, now you don't have to do anything with it. Government's going to protect it. That's what they said, man. They said they're going to backstop any amount at any bank. So,
to answer your question, I think they bailed SVB out because of the contagion effect, where a bank that's just in farmer land, like you talked about Arkansas, okay, you're going to lose some farmers. Big deal. It's not contagion around the world. This was contagion, and that's why they stepped in. So will they do that for every other bank? I don't know. I think this one could have stopped the whole contagion, and people are, like we're talking about, you feel safe now because the government's always going to be there, but they don't have to be there again because it's not going to happen again because they stopped the fear. You see what I'm saying? So by them stepping in, it changes the psyche of the consumer to say, "Oh, the government's here. We're okay. We don't have to run it to our local PacWest or First Republic." And I think that's why they stepped in. They realized it would be a contagion issue.
Like a firestorm on social media.
They don't you think they saw that? Absolutely. And they see what's happening.
Yeah, just like Jason was saying earlier.
Could have caused another stock market crash.
I think people are waking up to the fact that keeping money in the bank is not a completely risk-free exercise, right? Like, not only are you losing your money to inflation, there's potential risk exposure in these banks. Some of these banks may not be such a great steward of your money. And given where I am, I mean, to me, it seems like I want to buy assets with that money, not just keep it in the bank.
Yeah, that's what I was going to talk about. I mean, so like the old saying goes, safe as money in the bank. I'm like, which bank? Because I don't know which bank we're talking about here. So I think it's important to understand that also another way that I try to minimize my exposure to risk. I mean, because I keep money in the bank. I'm not going to keep all my money just like on me, like in my kitchen countertop, like hidden in a drawer somewhere, nobody's going to do that. So what I do is I put my money in multiple different national banks, like PNC, US Bank, Wells Fargo, Bank of America, Chase, Citi, all those. I got accounts with all of them. And I spread the love around a little bit. How about you guys?
Absolutely. I mean, you got up until those insurance limits, but you asked a minute ago, what if you have $10 million? Where do you go? You can't manage opening up how many banks,
right?
So you're going to have risk in every asset. Now we're starting to realize the risk in the banks. There's a risk in treasury bills. If you go buy treasury bills, you're buying a government note that they have the full faith and credit of the printing presses in the basement. So anything goes wrong, they'll start printing to give you your money back. But if interest rates go up, the value of that could still go down. So you're still not safe there from market risk, interest rate risk. There's a lot of risks involved in real estate, stock market, buying treasury bonds. So you're never going to get away from the risk to protect that money. It's always at risk. And that's what people don't understand. They all think they're safe in a bank.
Right.
So they put all this money in thinking the bank's not going to go belly up.
That's a good point. Happened. Yeah, that's a great point, actually.
Obviously, just diversification of your holdings.
Absolutely.
You got to spread them around. You got to have, all the bulge bracket, investment banks in New York and, some of your credit unions and things like that. And I think that's how you do it.
Yeah, I mean, I keep some of my cash on hand. I'm not going to lie. I keep a little bit of cash on hand in case the bank goes down or we have a major power outage or something, or somebody attacks the ATM networks, right? And all of a sudden you can't get your hands on any cash. I mean, that'll cause a run on the banks too. I mean, if people can't access their money that they've worked for, I've discovered when they can't access it like at will or readily or whatever, they start to freak out a little bit. Like I tell people all the time about whole life insurance policies. If you put your money in a whole life insurance policy, you can get it back, especially whenever you have the investment grade type, you can just get your money back in like 3 days if you need to. You can borrow against it, and that freaks them out. I'm like, it's no different than keeping it in a bank. You just got to sign some forms and they wire it directly to you. No. I don't like that. I'm going to go stick it over here at SVB Bank. I think it's much safer over there. But that's another thing. Keep cash on hand. I mean, in case there's a power outage. And me, I like to invest in real estate. I love real estate. Nobody's going to come and take it. I mean, cash can be erased. We just saw that.
Absolutely.
We literally just saw. I mean, let's think about it. How much cash was in that bank? Like $42 billion, right?
I don't know the exact amount, but it was a lot.
No, I thought it was more.
Right. I mean, that's enough. We could probably fill up almost the entire Whole Foods with $100 bills, like stack it to the doors. That's about 42 billion and all that just erased like that. It's just numbers. It's on a spreadsheet. I'm just like, cash can be erased. What are your thoughts, man?
I agree with you. I mean, I think that, leaving cash in a bank is risky. I think if you're fortunate enough to have $10 million in the bank, you probably have some wherewithal to kind of work on diversifying it and investing it and things like that. I think that a lot of my clients that are wealthy, I see them, they have a ton of bank accounts, right? It makes my job as a forensic accountant more difficult. But, what I like to see is what are the wealthy people doing, right?
How many accounts do they have? I'm curious. Like, how many accounts are we talking here on the average?
Someone that's worth tens of millions of dollars, they may have a couple dozen accounts because they're in private equities. Let's say they're
all in different banks,
different institutions, different investments, things like that. Because I think they want to be diversified. They want to be rich forever. They don't want to be just riding the current wave that's going on. Right. Yeah. So they're building real estate holdings, private equity holdings, traditional investment holdings, things like that. So I think that real estate's a great option, but as you could imagine, higher interest rates make the real estate game a little harder to play. Yeah. Because, like for example, you have some rental properties, they may not be cash flowing if you bought those properties at a 7% rate, right? Let alone a 3% rate.
I mean, I didn't do that. I know people out there that are doing that, but I didn't do that.
Well, I think that, and that's the reason why I think that this is kind of just the tip of the iceberg, because we've only been dealing with these higher level of rates for like about a year, right?
Yeah.
So
and
like,
there's a lagging effect to all this stuff. There's
I agree
6
with
months
that.
to really trickle in.
I 100% agree with it. There is a lag time effect. Yeah, you brought up a great point there, Jason.
yeah, and I'm just trying to control what I could control, right? Like you can't control these banks, you can't control the government. You know, I'm just kind of focused on myself. And to be honest, I didn't really watch the news until you're like, hey, come on this podcast and talk about this bank, because I don't want to buy into the hype. I don't want to, when things are good, I don't want to get too excited. When things are bad, I don't want to get too worried. I think you need to just focus on your local economy, right? Your household, how much money you could make. I think that's the takeaway here is like bet on yourself. You know, you don't want to rely on any bank or institution. They're not going to be looking out for you. You have to look out for yourself.
Yeah.
So what was we talked about how much assets were at SVB Bank. So you said, what did you say?
I said
got the number.
I said 42 billion.
What do you think?
I'd say over 100.
What do you think?
I think it was like close to 200 billion, right?
342 billion in client funds.
Oh my God. That's a staggering amount of
And
money.
they had 75 billion in loans on the books.
Wow.
So we're talking, this is a big bank.
That's a big bank. I mean,
It's a big bank.
15th largest, I think.
Yeah, let's say it's 14th. And they're already advertising on their website the new Bridge Bank.
yeah.
So it's Silicon Valley Bridge Bank. All deposits are 100% secure. And that's
Wow.
their advertising on their website when you go to their website.
They just flipped
so they're
it like
still
that.
in business.
They just flipped it like that.
They're still in business.
Yeah. What are your final takeaways on this?
I said this the other day. I mean, I think that this is just the beginning of some major shifts in the market, right? We're starting to see a little pain, and pain sometimes is good.
Yeah.
It creates opportunity, and we got to see how deep this gets, because, I get it in Silicon Valley, and there could be some sort of political agenda, which I'm a big believer that there probably is.
I agree.
They were more right about woke than they were with their deposits. So
That's when you know. That's when you know.
At the end of the day, I think there's definitely going to be some more issues. I think the last 48 hours, we've seen a dead cat bounce in the markets. And I think the stock market will see on the Dow 25,000 before it goes to 30,000. And remember, I said that.
Okay. Got it. It's on tape. Go ahead, Howard.
Yeah, I think that there's going to be a lot of consolidation in the banking industry. It happens all the time when you have shocks like this to the system. It'll go on for a few years. There's going to be new regulation. Has to come in with regulation on, like I said earlier, hedging and how they manage their hedges. There's going to have to be protocols on that to bring back the confidence. But yeah, I don't think this is over yet. But I think the contagion and the fear is over. Now it's going to just be calculated chaos going forward and not fear chaos going forward.
One of the things, if I can just add to that, is the market hates uncertainty.
Absolutely.
And so when there's uncertainty, you get the dislocation.
Absolutely.
So right now, the government is trying to take away uncertainty, but the rising interest rate still brings uncertainty. You don't know what's going on. So we'll see how it plays out over the next, the third and the fourth quarter. But I think that the second half of the year into the fall could be a rough time. But then I think, in my opinion, in 2024, we'll start to see interest rates come down aggressively. And I think you'll see things, and it's not like things are bad. I mean, inflation means that people are spending and there's things.
Right. I mean, like I was saying earlier, every single restaurant that I go to here in Palm Beach Gardens, every single night, and I just ride by them. I don't even go to them, right? They're packed, jam-packed with valet parking. Like we're talking for lunch. We're talking for early dinner. We're talking for late dinner. We're talking about for late night drinks. I'm telling you, just packed. Like any day of the week, you name it. Doesn't matter. I'm like, I've never seen anything like this in my life. Like, it's unbelievable, because I look around at my wife. I'm like, look at all this inflation right here. Just look at it. All this inflation, how it's affecting these people.
I would say it's, past few years have been a very exciting time, right? Like you could be successful overnight, but I think that the lesson that this teaches us is you could also go bankrupt overnight as well. And I think it's just, we're living in an age where everything's just kind of supercharged. Success is supercharged, failure is supercharged. And I think that it wakes everyone up to the fact that, you always have to prepare for the worst case scenario for your life, for your business, for your money. And I think that this is just the beginning, but I think that people could use this as a wake-up call to really de-risk financially.
Yeah. No.
Agreed.
I agree. What about you? Yeah? All right.
Absolutely.
Fantastic. Gentlemen, I want to say thanks for being on this podcast, man. I know we pulled this together at the last minute. And for anyone listening, I literally, Billy texted me a quick article and I was like, oh my God, we should do a podcast on this. And I literally reached out to Richard over here on the boards. I was like, hey man, look, I want to do X, Y, and Z. Can you get me somebody? And then I think I reached out to you, Jason. You're the first person that came to my mind after Billy. And I was like, let me see if Jason will do it. Bam. And then Richard brought in Howard. And I mean, this happened literally over the last 48 hours. I mean, so I want to thank you all for being here. I really appreciate it. We're going to drop this thing tomorrow. And at the end of the day, man, I mean, this is something that's going on in the marketplace, whether or not the people choose to acknowledge it or the government choose to acknowledge it. But listen, at the end of the day, we want you to walk away, feel confident, know what to do, have an action step, and know what to do with your money. Thank you so much for joining us today.
Awesome. Thanks, Jason.
Thank you.